Hi, this is Adam Hewison. I'm coming to you from the digital studios of MarketClub, and it's good to be back. As many of you know, I was in Australia and New Zealand for my daughter's wedding, but that was then a wonderful event, and this is now. Let's look at the markets. The market we're looking at today is the S&P 500. We've looked at this market many times before, and it's interesting to note I left in late December, and the market's actually lower than when I left. So it bears watching and seeing what this market's going to do in the future. So let's do a couple of things. As you can see, we're right here, and generally speaking, we have had a big down pull. This is obviously in the 08 time period. We had the recovery, we had the buy signal in our trade triangles that came in right around this period of time, and it's quite a nice move up on the monthlies. But what's happening now? Is the market rolling over? Are we going to go down, or are we going to continue to go higher? That's the question. So let's take this off the screen and let's look at some of our tools that we have, see what we come up with. First of all, I think you want to be looking at the Fibonacci. We've talked about this before, so you click on here, and to create a Fibonacci lines, the retracement lines, you simply go from the highest point to the lowest points. I'll show you how to do that. So you click here, drag this down. It's so easy. Drag this down, and we put it on the low period. Now, the theory behind Fibonacci is this, is that when you're seeing a retracement back to the 50% level, which is right here, or the 61.8% level, the markets tend to reverse. Now, we have had, obviously, as we said, a big down push in 08 when the recession crash, depression, however you want to call it, was not a good time. We've subsequently had the recovery, and the recovery has taken the market back to this 50% level, which we've mentioned before. This is a very, very critical area. The other thing that we have seen, which I will show you now, is that our weekly trade triangles, which are right here, actually gave a signal around 114, I should say 1,114 level to exit any long positions in this market. I think it's very important to be out of this market at the moment. You'll have plenty of time to get in, either on the long side, should it go back up, or on the short side, should it go down. But right now we're advocating not being in this market. The action of the last few days, and I'll scope this in a little further for you, the action of the past few days has been quite negative. In fact, you can see as we scope this in, we've seen a fairly I'm going to scope it out just a little further. We've seen a fairly sizable move down in just a couple of days, based on maybe expectations, but this was a very, very dramatic move these last 3 days. Now, we're going to close lower for the week, obviously, and that's not a good sign. You've also got your MACD line, which is crossed, which is also a negative. Plus you have, we've talked about this before, these divergences. So the market's actually going lower, the momentum is pointing down, or in this case like slowly down, and you're seeing prices go up, which means the market momentum is not following the price action. Now, with the market turn down here, indicates we're probably going to see more defensive action in this market. Now, we could potentially see a little rally back up here, but it seems to me that we could be turning down in this particular index, particularly with some of the things that are coming along, potentially coming along in the banking sector and also in interest rates in the US. So here we have it. The market looks as though it's in the thin air zone. We talked about this before, right around the 50% retracement level. Plus what you also have is this, and I want to show you this on triangles. So let me take this off the screen. I'm going to put in our monthly trade triangles, and as you can see quite readily, the weekly is negative from the 1,114.81, which we talked about just a few seconds ago. The daily is negative. The only one that's positive is the monthly, and that's important. It's saying that the major trend is still up in this index. I'm going to scope this out just a little bit further, and you can see right here, this is where the monthly got long, right around at 888.70. That's when this market got long. And as you know, we use our monthly trade triangles for trend and our weekly trade triangles for timing. Now, if I put the weekly triangles in, you can see we had a triangle here at 1114.81 to exit the market. Not to go short, but to be out of the market. One should be in a defensive position in cash and not be in the equity markets at the present time based on our trade triangle technology. Hey, this is Adam Hewison. I hope you found this little tutorial, a look at the S&P 500 interesting and informative and above all educational. This is Adam Hewison for MarketClub. It's good to be back, and we'll be knocking out some more videos for you in the next few days. Thanks for watching.